I learned a long time ago that the market does not reward hope, and it certainly does not reward excitement. It rewards patience, and it rewards the man who waits for the odds to line up in his favor. That is what people mean when they talk about high probability setups, though few really understand it. Most traders are busy trying to predict every tick, every turn, every whisper of the tape. But tell me, have you ever seen the market bend itself just to please one impatient mind? When I speak of a high probability setup, I am not talking about clever indicators or secret formulas. I am talking about situations where the market itself is practically announcing its intentions, if only you are quiet enough to listen. The big money does not rush. It moves with purpose, and when it moves, it leaves footprints on the chart that any disciplined observer can see. The trick is not seeing them once or twice, but waiting until they appear again and again under the same conditions. That waiting, I assure you, is where most traders fail. You see, a trader must first accept that he will not trade all the time. If you feel the urge to be in the market simply because it is open, ask yourself why. Is it because you see a genuine opportunity, or because you are bored, restless, or afraid of missing out? The market has a way of punishing those emotional decisions swiftly and without apology. High probability setups appear rarely, but when they do, they are unmistakable. The market is generous enough to offer them, but only to those who have the patience to stand aside the rest of the time. A high probability setup begins with the trend. That may sound too simple, but simplicity is often what fools people. The path of least resistance is not a theory, it is a fact written plainly on the chart. When prices are making higher highs and higher lows, that is the market telling you it wants to go higher. When they are doing the opposite, it is telling you something else. Why argue with that? Why fight a tide that is already moving with great force? I have always found it strange that traders try to buy at the top of a move or sell at the bottom, as if those points were easy to spot in real time. The smart operator waits for a reaction within a larger trend. He waits for the market to pull back, to hesitate, to shake out the weak hands. Then he watches closely. Does the selling dry up? Does the tape grow quiet? When price stops going down on bad news, that is often good news for the prepared trader. Have you trained yourself to notice when the market refuses to go lower? Volume, too, speaks a language of its own. A high probability setup is rarely quiet in volume at the wrong time. When a market advances on expanding volume and reacts on lighter trade, it is behaving properly. That is the market acting healthy, even when it scares the public. If, on the other hand, prices are rising on thin volume and breaking down on heavy selling, the odds are not in your favor. Why take a position when the evidence is already warning you? One of the great mistakes traders make is confusing activity with progress. A high probability setup does not require constant action. It requires correct action. You wait, you observe, and when the conditions you have studied appear, you act decisively. Not emotionally, not impulsively, but decisively. And when you act, you already know where you are wrong. That point of being wrong is what protects your capital. Without that, you are not trading, you are gambling. Is your first thought about how much you can make, or about how much you might lose if you are wrong? Risk control is not a side topic. It is the foundation of every high probability trade. Even the best setup will fail from time to time. The market does not owe you a profit simply because you did your homework, but when you keep losses small and let profits run in your favor, the arithmetic begins to work for you. This is how wealth is built in trading, not by one great stroke, but by a series of well-managed decisions repeated over time. Can you accept small losses calmly, or do they disturb your sleep? Your mindset, more than your method, determines whether you can trade high probability setups successfully. You must think in probabilities, not certainties. The moment you need to be right, you are finished. The professional trader does not care about being right. He cares about being profitable. He knows that a single trade means nothing by itself. It is merely one event in a long series. That perspective gives him emotional distance, and that distance gives him clarity. Another mark of a high probability setup is confirmation, not the kind that comes from a dozen indicators all saying the same thing, but confirmation from price itself. Breakouts that hold, pullbacks that respect prior levels, trends that resume after a pause. These are not coincidences, they are expressions of supply and demand. When demand overwhelms supply at a known level, price moves. When supply overwhelms demand, it falls. The chart is nothing more than a record of that struggle. Are you reading it as a story, or just staring at lines? I have often said that the big money is made by sitting, not trading. That sitting is not laziness, it is discipline. You wait through dull markets. You wait through choppy action. You wait through false starts. And then, when the market aligns with your rules, you move. High probability setups reward that patience handsomely over time, not because they win every time, but because they tilt the odds just enough in your favor. And in speculation, that is all you ever really get. As your account grows, your responsibility grows with it. Larger size magnifies both errors and discipline. This is where mindset and money management merge. You cannot trade large size on hope. You can only trade it on clear reasoning and proven setups. The trader who survives long enough to compound his capital is the trader who respects the market's power at every stage. So when you look at a chart tomorrow, do not ask what might happen next. Ask what is happening now, and whether it fits your highest probability conditions. Ask yourself if the market is inviting you in, or daring you to make a mistake. The market is always speaking, but it speaks softly, and only to those willing to listen just a little longer. High probability begins with clear market direction, and that truth has ruined more careless traders than bad luck ever did. The market is always moving somewhere, but not every movement has meaning. Most of the time it is merely wandering, shaking out the impatient and entertaining the hopeful. The trader who confuses movement with direction is already in trouble. Direction is not a guess, and it is not a feeling. It is something the market shows you plainly if you have trained yourself to see it. A market in clear direction does not argue with you. It does not hesitate endlessly. It makes progress. Higher highs and higher lows tell one story, and lower highs and lower lows tell another. Anything else is noise. The difficulty is not in understanding this idea, but in respecting it. Many traders know this in theory, yet ignore it the moment excitement enters the picture. They see a sharp move and rush in, never stopping to ask whether that move fits within a broader direction. Have you ever taken a trade simply because price was moving fast? Clear direction creates structure, and structure creates opportunity. Without structure, you have no reference points. You do not know where you are wrong, and if you do not know that, you cannot manage risk intelligently. A trend gives you a framework. It tells you where pullbacks should stop, where resistance should fail, and where momentum should resume. When price behaves in harmony with that framework, probability shifts in your favor. When it does not, probability slips quietly away, often before you realize it. The public loves tops and bottoms because they promise excitement and ego satisfaction. Being early feels like being smart, but early and wrong feel exactly the same in the account. High probability traders are not interested in calling turns. They are interested in participating in moves that are already underway. Direction is proof that money has committed. Large interests do not move in and out lightly. When they establish a position, the trend reflects their presence. Why try to outguess that kind of capital? Clear market direction also simplifies decision-making. When the trend is up, your job is not to find reasons to sell. It is to wait for conditions that allow you to buy with reduced risk. When the trend is down, you are not hunting for bargains. You are waiting for rallies to fail. This alignment removes confusion and emotional conflict. Many losses come not from bad analysis, but from internal contradiction. You buy while secretly fearing a drop, or you sell while hoping for a bounce. Direction eliminates that mental tug of war. A market without direction demands prediction. A market with direction demands patience. Prediction drains energy and confidence. Patience builds both. When direction is clear, you can afford to wait for the right moment. You are not desperate for action, because you know opportunity will return as long as the trend remains intact. That knowledge steadies the hand and sharpens judgment. Do you feel calmer trading with the trend, or do you feel the urge to force trades when nothing is clear? Direction also protects you from overtrading. Choppy markets tempt traders into constant action, promising small wins that rarely survive costs and mistakes. Clear direction reduces the number of decisions you must make. Fewer decisions mean fewer emotional errors. This is not laziness, it is efficiency. The trader who trades less but trades well compounds capital more reliably than the trader who is always busy. Another important truth is that direction exists on different time frames, but probability improves when they agree. A short-term move against a dominant long-term trend is a lower probability proposition. It can work, but it requires precision and speed. High probability setups favor alignment. When the larger trend supports your trade, mistakes become more forgiving. When it does not, even correct entries can fail quickly. Are you trading with the dominant force, or trying to slip against it unnoticed? Clear direction also shapes expectations. In an uptrend, you expect higher prices over time, not immediate perfection. Pullbacks do not frighten you, they interest you. In a downtrend, rallies do not excite you, they invite caution. This shift in expectation is subtle but powerful. It keeps you from reacting emotionally to normal market behavior. Traders who lack this perspective often abandon good trades too early or hold bad trades too long. There is also a psychological comfort in trading clear direction that cannot be ignored. Confidence does not come from winning one trade. It comes from knowing you are operating within a sound framework. When direction is clear, your decisions feel deliberate rather than hopeful. You are not asking the market to do something special for you. You are simply participating in what it is already doing. Wealth in trading is not built by brilliance, but by consistency. Consistency comes from repeating behaviors that favor probability. Clear market direction is one of those behaviors. It is the filter that removes marginal trades and highlights meaningful ones. Ignore it, and you invite randomness into your results. Respect it, and you give yourself the only edge speculation ever offers. When you sit down to analyze a chart, your first question should never be about entry or profit. It should be about direction. Until that is answered honestly, everything else is premature. Many traders rush past this step because it feels too simple, too obvious. Yet the market has always punished those who overlook the obvious. High probability does not begin with clever tactics or advanced tools. It begins with accepting what the market is already doing and aligning yourself with that reality. When direction is clear, you are no longer fighting the market. You are walking beside it, waiting for the moments when it pauses just long enough to let you step in, and when those moments appear, you must already know whether the market is truly leading or merely pretending to move somewhere it has no intention of going. Trade only when price, trend, and timing agree, because when even one of those is missing, the trade becomes an argument instead of an opportunity. The market does not reward arguments. It does not listen to opinions, and it certainly does not care how convincing your logic sounds. It rewards alignment. When price, trend, and timing are in harmony, the trade feels obvious, almost dull, and that dullness is often the trader's greatest advantage. Price is the final judge. Everything else is secondary. You can study news, reports, forecasts, and theories until your eyes ache, but none of it matters if price refuses to cooperate. Price is the market's verdict, delivered in plain sight. When price is moving smoothly in one direction, respecting prior levels, holding gains, or pressing lower without hesitation, it is telling you something important. Ignoring that message is like ignoring the scoreboard in a game and insisting you are winning because you feel like you should be. Trend gives price its context. A single price move without trend is just noise. Within a trend, that same move becomes meaningful. The trend is the market's memory. It shows where capital has committed and where it has withdrawn. When you trade against it, you are betting that something stronger than existing pressure is about to appear. Sometimes it does, but more often it does not. High probability traders do not build strategies around rare exceptions. They build them around what happens most often. Timing is what separates analysis from execution. Many traders are right about direction and still lose money because they are early, late, or impatient. Timing is not about perfection. It is about synchronization. Entering when price is extended, even in a strong trend, shifts probability against you. Entering during consolidation or pullback, when momentum pauses but structure holds, improves your odds. Have you ever noticed how many losses come from being right too soon? When price, trend, and timing agree, you do not need excitement. The trade does not require persuasion. You are not forcing yourself to click the button. The setup presents itself clearly, and your job is simply to act according to your rules. This is why preparation matters more than intelligence. In the moment of decision, there is no time for debate. Either the conditions are present or they are not. Many traders make the mistake of treating these three elements as optional. They allow price to override trend or timing to override structure. They convince themselves that a fast move justifies ignoring the larger picture. This is how discipline erodes quietly. Each exception seems harmless, even logical, until the account begins to reflect a pattern of inconsistency. Probability does not collapse all at once, it leaks away trade by trade. Alignment creates clarity. Clarity reduces emotional interference. When all three elements agree, doubt has little room to operate. You know where you are wrong, and that knowledge is calming. Fear thrives in uncertainty. Confidence thrives in structure. This is not confidence in winning, but confidence in process. The market may still do anything it pleases, but you know you have approached it correctly. Trading only when price, trend, and timing agree also limits activity, and that is a blessing disguised as restraint. Fewer trades mean more selectivity. More selectivity means better average outcomes. The market is always offering action, but it is rarely offering opportunity. Learning to tell the difference is one of the hardest lessons a trader faces. Do you feel uncomfortable when you are not trading or relieved? There is also a financial truth hidden in this principle. Compounding does not require constant participation. It requires survival and steady progress. Every unnecessary trade exposes capital to risk without sufficient reward. Over time, those small, unnecessary risks add up. Alignment reduces exposure to randomness. It concentrates risk where probability justifies it. Timing deserves special respect because it tempts impatience more than any other element. A trader sees a trend and knows price will likely move further, but waiting feels like wasted time. So he enters early, before price confirms. When price moves against him, he feels betrayed, even though the market did nothing wrong. It simply followed its own rhythm. High probability traders respect that rhythm. They wait for price to invite them in. When timing is right, price often moves with surprising ease. There is less struggle, less hesitation. Trades that work tend to work faster and cleaner. Trades that fight you from the start are often telling you something important. Listening early can save both money and confidence. Do you give trades time to work, or do you ignore early warnings because you want to be right? This principle also strengthens patience outside of trades. When you know exactly what you are waiting for, waiting becomes purposeful. You are not scanning charts anxiously. You are observing calmly. You are not hoping for something to happen. You are prepared for when it does. This mindset shift is subtle but powerful. It transforms trading from emotional reaction into deliberate execution. Trading only when price, trend, and timing agree does not eliminate losses. Nothing does. But it ensures that losses occur within a framework you understand. That understanding prevents frustration from turning into recklessness. A trader who knows why he lost can continue. A trader who feels cheated by the market often seeks revenge. Over time, this alignment becomes instinctive. You begin to sense when something is missing. A trade may look attractive on the surface, but it feels incomplete. That feeling is not intuition in the mystical sense. It is experience recognizing imbalance. Respecting that signal is part of maturity. The market does not demand that you trade. It demands that you respect it. When price, trend, and timing agree, respect is returned in the only form that matters. And when they do not, the wisest decision is to remain still, watching, waiting, allowing the market to reveal whether alignment is forming or whether it intends to continue without you. Because there will always be another opportunity, but only if you remain capable of taking it. Fewer trades, better decisions is a lesson the market teaches slowly and at great expense. Most traders arrive believing the opposite, thinking activity equals progress. that being busy must mean being productive. The market encourages this illusion by offering endless movement, endless candles, endless chances to click a button. But the market is not impressed by effort. It only responds to judgment, and judgment weakens when decisions are made too often and without discrimination. Every trade is a decision, and every decision carries emotional weight. Even when you believe you are acting mechanically, something inside you is reacting. Hope, fear, pride, impatience, all of them show up whether invited or not. The more trades you take, the more frequently those emotions are stirred. Over time, they accumulate, and clarity begins to blur. This is not a flaw of character, it is a reality of human psychology. Have you ever noticed how much sharper your thinking feels after a period of restraint compared to a day of non-stop trading? High-probability traders understand that opportunity is not evenly distributed. Most of the time, the market is doing very little of value. It is digesting prior moves, balancing orders, confusing participants. During these periods, trading becomes guesswork dressed up as analysis. Fewer trades force selectivity. Selectivity forces standards. Standards protect capital. This chain is simple, but few respect it because it denies the illusion of control that constant action provides. When you trade less, you observe more. Observation sharpens perception. You begin to notice subtle details you would otherwise miss. How price behaves near important levels. How volume changes before a move. How strong trends pause before continuing. These observations do not come from frantic participation, they come from distance. The trader who is always in a position is rarely in a position to learn. There is also a practical benefit that cannot be ignored. Every trade has a cost. Commissions, slippage, spread, mental energy, all of them subtract quietly from results. When trades are frequent, these costs compound against you. When trades are selective, they become negligible relative to reward. The market does not reimburse you for effort. It only pays for correctness, and even then, only partially. Better decisions require space. Space between trades allows emotions to settle. It allows you to review without bias. After a loss, immediate re-entry often has less to do with opportunity and more to do with discomfort. The desire to recover quickly clouds judgment. By trading less, you reduce the chance of emotional chaining, where one decision influences the next in unhealthy ways. Do you ever notice how a single loss can change your behavior for the rest of the day? Fewer trades also improve consistency. Consistency is not about winning often, it is about behaving predictably. When your rules are applied only to the best setups, results become easier to analyze. You can identify what works and what does not. When trades are taken indiscriminately, outcomes blur together. You may make money, but you will not know why. And what you do not understand, you cannot repeat deliberately. The mind prefers simplicity, even if it pretends to crave complexity. Trading fewer setups simplifies execution. You know exactly what you are waiting for. You know what conditions must be present. When they are not, there is no internal debate. You simply wait. This removes friction from decision-making. The absence of friction preserves confidence, and confidence allows correct action when the moment arrives. There is a common fear among traders that fewer trades mean fewer profits. This fear is rooted in misunderstanding. Profit is not a function of trade count, it is a function of expectancy. A single high-quality trade can outperform 10 mediocre ones. Over time, the trader who focuses on quality experiences smoother equity growth, while the trader who chases quantity experiences emotional swings that sabotage discipline. Which curve do you think is easier to live with? Fewer trades encourage patience, and patience is not passive. It is active restraint. It is the ability to say no repeatedly until the right yes appears. This restraint builds trust in your process. You stop needing constant validation from the market. You no longer measure your day by how many trades you took, but by whether you respected your criteria. That shift changes everything. There is also a subtle confidence that comes from selectivity. When you trade less, you take each trade more seriously. Position sizing is more deliberate. Risk is clearer, execution is calmer. You are not clicking out of habit. You are acting with intent. That intent is felt internally, and it affects how you manage the trade once you are in it. Overtrading often disguises itself as discipline. A trader convinces himself he is following rules, but the rules are loose, flexible, easily bent. Fewer trades expose rule breaking immediately. Either the setup meets criteria or it does not. There is no room for justification. This honesty is uncomfortable at first, but it is necessary for growth. Markets reward those who wait for imbalance. Imbalance does not occur constantly. When it does, it is usually brief. Traders who are exhausted from overactivity often miss it. Their attention is scattered. Their confidence is shaken. Fewer trades conserve not just capital, but focus. Focus allows recognition. Recognition allows action. As capital grows, the importance of fewer trades increases. Larger size magnifies mistakes. What was once a small error becomes a meaningful drawdown. Traders who learn to survive through activity struggle at this stage. Traders who learned restraint adapt naturally. Their process already assumes selectivity. Their mindset already respects scarcity of opportunity. Fewer trades also align trading with long-term wealth-building principles. Wealth is built through compounding, and compounding requires stability. Wild swings interrupt growth. Consistent, modest gains accelerate it. The trader who trades less often but with higher quality creates conditions where compounding can work quietly in the background, without emotional interference. When you review your trading history honestly, patterns emerge. Many losses come not from bad ideas, but from unnecessary ones. Trades taken because something almost fit. Trades taken because nothing else was happening. Trades taken to feel involved. Removing these trades often improves results immediately, without adding anything new. The market is always open, but opportunity is not. Accepting this truth is a turning point. It changes your relationship with time. Waiting no longer feels like wasted effort. It feels like preparation. You stop chasing movement and start waiting for meaning. Discipline turns probability into consistency, and without discipline, probability is nothing more than a pleasant theory. Many traders understand probability intellectually. They know that no setup works every time, that losses are part of the business, that edges play out over a series of trades. Yet knowing this does not guarantee living by it. The gap between understanding probability and benefiting from it is discipline, and that gap is where most accounts disappear. Probability only works when it is allowed to work. One trade proves nothing. 5 trades prove very little. It is the repeated application of the same behavior, under the same conditions, that allows probability to reveal itself. Discipline is what keeps you applying that behavior when the last trade lost, when the one before it won, and when the market seems determined to test your patience. Have you ever abandoned a sound approach simply because it disappointed you for a short time? The market is a master of temptation. It offers just enough randomness to make you doubt your rules. A disciplined trader accepts that randomness is part of the cost of doing business. An undisciplined trader tries to eliminate it by adjusting, tweaking, interfering. Each adjustment feels reasonable in isolation, but together they destroy consistency. Probability cannot operate in chaos. It requires a stable framework, and discipline is what keeps that framework intact. Consistency is not about smooth profits. It is about consistent behavior. The market may change its mood, but the disciplined trader does not change his process impulsively. He reviews, he studies, he adapts slowly and deliberately, but he does not react emotionally. This steadiness allows probability to express itself over time. Without it, results swing wildly, not because the market is unpredictable, but because the trader is. Discipline begins before the trade, not during it. It begins in preparation, in knowing exactly what you are looking for and what you will ignore. The market presents countless possibilities every day. Discipline filters them. It says no far more often than yes. That refusal is not hesitation, it is strength. The trader who lacks discipline feels pulled by every movement, every headline, every sudden spike. The disciplined trader remains anchored to his criteria. Once in a trade, discipline becomes even more important. Probability assumes proper execution. Stops must be honored. Targets must be respected. Position size must remain appropriate. Breaking these rules does not increase probability, it negates it. A trader who moves stops to avoid pain is not unlucky, he is undisciplined. A trader who takes profits early out of fear is not cautious, he is interfering with expectancy. How often do traders sabotage winning systems by refusing to sit through normal discomfort? Discipline also governs when not to trade. Knowing when conditions are unfavorable is just as important as recognizing opportunity. Low probability environments exist, and they can persist longer than expected. Discipline keeps you on the sidelines during these periods. It preserves capital, confidence, and focus. Without discipline, inactivity feels intolerable, and the trader invents reasons to participate. Those reasons are rarely rooted in probability. There is a misconception that discipline is rigid or mechanical. In reality, it is thoughtful and intentional. It does not eliminate judgment, it structures it. Discipline ensures that judgment is applied consistently rather than emotionally. It allows flexibility within defined boundaries. This balance is subtle and difficult, but essential. Traders who mistake discipline for stiffness often abandon it prematurely, claiming it limits them, when in fact it protects them. Consistency in results is the outcome of consistency in actions. You cannot behave randomly and expect stable outcomes. This seems obvious, yet many traders do exactly that. They trade well one day and impulsively the next.